What are you seeing just in real time that the bond markets are doing? And then let's talk about growth. Let's talk about credit contraction and just some of the things that are kind of looming on the horizon and what the data is telling us.
Yeah, 100%. So, you're right in the money when we're talking about commodity prices, right? They've always been a great proxy for where the economy is headed, if it's moving into expansion or if it's moving into contraction. And really, what we're seeing in the truest sense here, in the way that the market is positioning, is for this big old contraction. Fed funds futures are great. They've been a great tool of mine over the last 6 to 9 months, and they are generally wrong for a period of time, right? When we're talking, like, we're still a month out from the meeting, they can still be very volatile. But when we are within striking distance of the meeting, let's call it, 3 weeks, as those final weeks trudge along, it basically ossifies right around what the Fed's going to do, and the market is becoming increasingly sensitive to new economic data that it didn't care about earlier in the cycle. And that tells me that markets are becoming more fragile. They're turning more on a dime. And even the least tradable events historically are now becoming very tradable because of how fickle they are. And so markets, despite this being, and I don't know if this is an expression that's used every recession, but you alluded to it. This is a recession that everyone expects.
Right.
Despite that being the case, markets are still really turning on a dime to reports that they don't usually care about. And the report that I'm referencing is the JOLTS data. This is job openings. Generally speaking, this is like one of the lowest signal economic data releases that you can expect. On the Bloomberg terminal, they have little like cellular bars, right? When you have good cellular connection, it's 4 bars. When you have bad, it's 1 bar. And the Bloomberg terminal uses that to sort of denote the importance of different economic data. And JOLTS has 0 bars. It has no bars. And so nobody references this at all. But yesterday, the only report that came out, the only substantial report that was released yesterday, was this JOLTS job opening data. And in response to this JOLTS data, well, I'll tell you what the data was first. Job openings declined rapidly, the most rapid decline in job openings apart from COVID in the last century, at least as long as it's been measured. And so
Hmm.
that's pretty massive. That's huge. And that shows that labor demand is drying up pretty substantially, right? And very, very quickly. Obviously, off of COVID and massive fiscal and monetary stimulus, companies hired up the wazoo because they just could, right? They allocated human and physical capital because it was just cheap to do so, and they were leveraging that. Now that we are heading into a period where you sort of have to pay the piper, right? Money isn't free anymore. Every single floating rate in the world is now at least 4.5%. You got to really pay up. Now, all this poorly allocated capital that was brought on, whether it's physical or human, is being slashed. It's being slashed from these companies. And so new job openings, right, are falling pretty precipitously. Now, normally this wouldn't matter, right? We have data releases where job openings rise, and data weeks where job openings fall. Usually, it's not the most tradable event, but for whatever reason, and I'm saying that the market is really turning on a dime. The market is scared. It's not expecting the severity of this downturn, is because this was like a hugely tradable event yesterday, and it usually is not. The rates market, off of this data, it repriced down on the front end by as much as 15 basis points, right? Twos, tens began uninverting to a very large degree. Twos Fed funds began inverting even more, right? Uninversion signals cuts, inversion of twos Fed funds signals a pause. And so the market began hunkering down after this data point. That doesn't normally happen. And it tells me, in confluence with all these other things, that even though this is probably the most anticipated recession of my lifetime, I've only lived through two or three, I suppose. The market is still not ready necessarily for the severity of it. It was very, very shocked by that job opening, the rapid decline in job openings. And as labor demand goes, eventually you will begin to see unemployment tick up rather materially. Unfortunately, unemployment comes out quarterly, but the beautiful thing about data is that there are other sort of leading indicators that we can use for when the labor market is going on. One, my favorite one, is initial jobless claims, and that comes out tomorrow, and I'm very excited about that, to see, with this the largest decline, as I said, barring COVID, in labor demand. what initial jobless claims look like. Will we see a rapid pass through of this into initial jobless claims, which will tell us that unemployment will be materially higher soon at the next print? Potentially. And I think that initial jobless claims tomorrow will sort of signal a lot of what is going to occur within the labor market and within the downturn more broadly. What we're seeing now with this credit contraction, we're entering the downturn phase of the credit cycle, where banks stop extending new credit to customers, be it consumers, be it businesses, be it property developers. And then as a result of that, those businesses, they have to obviously wind down their operations to some degree. They have to sell some of their existing property, let's say. They have to cut back on some of their own expenses, and so that is where the credit cycle leads into sort of the economic cycle, right? The economic cycle is expansion, contraction, expansion, contraction. Same deal with the credit cycle. And what the Fed has been trying to induce, this is exactly what the Fed has been trying to induce, rather, over the last year and a month since it started raising rates, and then in June when it started doing QT. When you are a hammer, everything looks like a nail. And in the Fed's case, all it has are interest rate monetary policy and the ability to buy assets directly from banks. That's it. It has its interest rates and it has balance sheet. And right now, its rates are no longer working. It really front loaded its hiking cycle because it knew the moment that this credit contraction started occurring and this flight to safety started occurring in treasuries, it wouldn't be able to transmit policy effectively anymore. And now we're seeing the outcome of that. The Fed has been trying to induce a slowdown in credit in new credit because that's the only way it can control inflation. All it has are these interest rates. And so we are starting to see that now. The Fed tightened aggressively out of necessity. And now the downturn that comes on the other end of it will be just as severe and just as aggressive. And we are just seeing the beginning parts of that now, right? Bank failures wasn't necessarily expected. But with those bank failures, obviously, the the process of banks extending less credit to consumers, businesses, and property developers, that is accelerating. And then obviously you will be able to see that in home prices. You'll be able to see that in the labor market, and you'll be able to see that in business activity, business sentiment, and that's being all of these things are sort of occurring all at once to some degree. When I'm talking about business sentiment, the Purchasing Managers Index, these surveys that go out to business managers within manufacturing and within the services industry, all of them are declining and declining rapidly, right? So business owners are basically surveying conditions are worse in X this month than they were last month. And so we are just at the beginning of this credit contraction and going into this growth slowdown. But all of these forward-looking indicators, right? These job openings, these surveys from business managers tell us that we're in the eye of the storm for now. Things are okay, but the moment we exit, things are going to get ugly once again.